There's a famous quote from Stanley Druckenmiller that goes like this. It's the Federal Reserve Board. Focus on the central banks and focus on the movement of liquidity. Most people in the markets are looking for earnings and conventional measures. It's liquidity that moves markets. Now think about that for a second. It's liquidity that moves markets. Now what even is liquidity? So I thought about how to deliver this concept in a way that is actually effective, because I want to make sure to deliver knowledge in a way that you can actually understand it and make use of it. So I don't want to make this too complex because, it can be. Liquidity involves interest rates, global growth, balance sheets, and all those things together make the whole thing a little bit too overly complex. So I want to spin this liquidity concept in a direction that makes it very practical, so you can actually fully understand it and apply it in your trading every time it happens. So you probably heard of central banks' balance sheets. Now bear with me a second, because in a minute you will actually see how this applies straight into the charts. But for now, think about this. A central bank can add or reduce liquidity, and they can do that with their balance sheet. Now, they don't do that just with the balance sheets, okay? But that's one of their ways they can do that. For instance, the injection of liquidity into the markets, it's the so-called quantitative easing. That's done increasing the balance sheet, while instead the reduction of the balance sheet is the so-called quantitative tightening. Now, QE is done to stimulate the economy, stimulate inflation, while QT is done to do the exact opposite, to start putting a cap on what could be an overheating economy. That's basic central banking stuff. Add liquidity to support the economy, or remove liquidity to slow economic growth. Now, side note, why would the central bank stop economic growth? Why would it do that? Well, one of the main mandates of a central bank is to achieve stable prices, stable inflation. And one of the things that raises inflation is retail spending. In other words, when the economy is doing too good, too long, too much, that can actually raise inflation. And central banks look at that as a threat for the longer term price stability objectives. So they cool off that by tightening monetary policy, by reducing liquidity, by slowing growth. So either they do that by raising interest rates, or with quantitative tightening, or both together. So, okay, with that in mind, that was just a little bit of theory to lay the context down for what we're going to talk about now. So let's see exactly how practically this applies to markets and currencies specifically. So let's start with quantitative easing first. This is actually the most famous of the two, the most popular of the two at least, because, the Fed implements QE when they need to stimulate inflation and economic growth. So hold on a second, because if you are an economist and you're listening to this, you're about to cringe, because what I'm about to say is factually incorrect. But for the sake of simplicity, think of QE as money printing. 2020 style, when the Fed turned on the printing machine, so to speak. So, with that in mind, purely from a supply and demand perspective, what happens to one asset, any kind of asset, when you print more of it? So when you increase the supply, but while meanwhile demand stays the same. So increase in supply, no increase in demand. The asset devaluates. So imagine QE as the Fed printing dollars and injecting those into the economy. Again, factually incorrect. The process is a lot more complex than that, and it does not involve actually money printing in a secret basement in Washington. But what happens to the domestic currency when a central bank prints more of it? It devaluates. That's the simplest and most effective way to think about QE. It's bearish for the domestic currency. Now, am I just making this up? Did I just invent this on a spot right here, right now? Of course not. Earlier, I've mentioned the large QE program that the Fed started in 2020. And in fact, that's the biggest QE program so far. So that's a great example to see how powerful this can be at setting trends. So that QE program started in early 2020, and then it was tapered down in late 2021. Again, you can see that exactly on the chart. QE is bearish for the domestic currency. But I know what you're thinking now. Is one instance enough to prove the point? Of course not. The Fed started a QE program in November 2008. The dollar topped right there. It started another one in November 2010. The dollar topped exactly there. And again, September 2012, another QE program started. Dollar topped. Okay. So, point proven about QE. Now, what about the opposite? So we have stimulated economic growth and inflation enough with QE and potentially also low interest rates. Now what we do to hold and lower inflation? We do that by tightening financial conditions, lowering asset prices, and increasing the value of the domestic currency. In other words, engineering a slowdown, engineering a growth slowdown to balance things out. Now, I get it. It sounds a bit cynical. Why would the central bank do that? Well, again, the point is that in the central bank's eyes, a short-term slowdown is much better than a longer-term period of inflation where they lose control of prices. So, what are the central bank's tools to reduce liquidity? Quantitative tightening and rate hikes. So while QE is the injection of liquidity into the markets, QT is the exact opposite. And as a result, obviously, the exact opposite effect is created with the strengthening of the domestic currency. Here is the 2022 QT program the Fed started, which, as you can see, started a meaningful trend in the dollar after the downtrend from the 2020 QE program. Now, here's also the QT program that started before this one in 2018, which also marked a zone from where the dollar then started to trend up for a couple of years. Now, both of these programs were done in a context of a high economic growth coming from a period of a large liquidity injection. The 2018 one obviously was coming from the multitude of stimulus programs started in 2008, and then 2022 coming from the 2020 stimulus program. Okay? So with all this said, I think you've seen now literally it's liquidity that moves markets. Now, like I mentioned at the beginning, the liquidity discussion goes above and beyond just QE and QT. There are rate hikes, rate cuts, global growth expectations, risk sentiment, and more. But for now, understanding QE and QT is already a big step in the right direction to make sure that you can actually use this and take action on it when it happens. Obviously, these don't happen too often, but it's another tool in your fundamental knowledge to make use at the appropriate times.